Hello, my name is Maxine. I am a youth program specialist for ASI, and I am proud to introduce the next part, our Adulting 101 series, which is Stocks with Professor William Stevenson. Could you please introduce yourself?
Hi, everybody. Thanks for having me, Maxine. My name is William Stevenson. I'm a professor at Cal State San Bernardino. I'm a banker by trade. Just excited to be here and maybe answer some questions that you might have about investing.
Yes, of course, because we had a lot of questions come in from students, but I first want to start out with a short summary or a summary of the mechanics of the stock market and how it all works.
Absolutely. Always, the stock market is always confusing, I think, to a lot of people in that they know it's there. They hear a lot about it. It's actually on the news, at least for a little bit every day. They talk about the market. But what is it? What are stocks? What do they represent? And in a nutshell, it's ownership of a company. It's ownership interest in a company. So if when a company goes public or is traded publicly, that means that the stock is traded amongst people who own a piece of the company. So the only time a company actually makes money on the stock is the very first time it's sold. So I would equate this to, say, buying a car from Ford. When you buy that car from Ford, Ford gets paid for the car, but now it's your car. And so if you ever sell that car to somebody else, that's a trade between you and that other person. You don't pay Ford again for the car because you own it. And that's the same with stock. So a company sells stock to raise money for a project or for some other reason, but they raise money, and then that stock is traded amongst people. So as you see the price go up or down, it's generally because of how well the company has done. In theory, at least, that's what should be moving the stock price. If a company is doing really, really well and they announce their quarterly earnings or they announce that they had a really good year, you would expect that the stock would go up in value. And it goes up or down in part because of those announcements and because of how the company does. But what drives that stock price more than anything is supply and demand, the simple economics of supply and demand. These are the fundamental keystones of economics. So if more people want the stock, then that has a tendency to drive the price up. Because if I'm sitting there holding my Google stock, and just for the sake of argument, let's say it's trading at $1,000 a share, and I'm holding on my Google stock, and I see the stock price of Google go up to 1,100, I go, yay, I feel really good about that. Maybe it goes to 1,200, maybe it goes to 1,500. But at some point I might go, ooh, I want to sell it, right? There's so much money now available that I'm going to actually sell it. So that I become one of the people that provides the supply, because the demand has gotten so high, the price of the stock goes up, I eventually sell mine. Of course, the reverse can be true as well. Company isn't doing well. It's not a good market for the company right now. If you were in the restaurant industry, clearly not a good time for restaurants because of the COVID pandemic. And so restaurant stocks, like cruise ship lines and hotels, are all experiencing this downward growth. And because there's not as much demand, if I want to get out of my Carnival Cruise Line stock, or I want to sell my restaurant stock, I would have to price it to a point where somebody would say, okay, I'll take it. Right? There's just so little demand for it right now. If that stock was selling for $1,000, and I go, okay, we'll sell it. Hello, nobody's out there buying it. Well, how about sell it for $980, $970, $950, $900? I mean, at what point is it where the price of the stock goes so far down that somebody goes, okay, I'll take it? And so supply and demand is what drives the market, in part. Other things can do it too. This pandemic had an effect. Any of the geopolitical activities in the world, California, can have an effect on the market. There's all kinds of goofy things. It's impossible, though, to predict where the market's going to go. Absolutely impossible to predict it. So one of the things that I always tell my students is, don't drive yourself crazy looking at the stock market. And don't worry about the stock market going up or down. Because what I want to talk to you guys about is not so much what are stocks and all that, but I really want to think about this concept of investing and investing for a purpose, right? The purpose of you doing that is so that you can eventually achieve what I would call financial security. You don't have to worry about money anymore, right? You have enough passive income coming in to make your expenses. And passive income is income you earn without having to work for it. So money you would get off of your stock portfolio, money you would get from a pension, money you would get from Social Security. Once you've earned those, you don't have to work anymore. And if you have enough of it to meet your expenses, you reach financial security, you're done, right? You're done working. And that's where I want you guys all to get at some point, down the road, much, much farther down the road. So the difference, I guess, between what you hear on the news, and it's a lot of these people chasing after the money, and what I'm going to tell you about, which is investing, is that I shouldn't say it doesn't matter, but it almost doesn't matter what you invest in, which stocks you hold, because you're not going to sell it for 40 years or 50 years from now. And so think about buying Amazon when it first came out, whatever that was, 20 years ago, 30 years ago. Think about buying Ford Motor when Ford first started out, or any of these companies when they first came out. That's what I'm talking about. Yeah, in the meantime, the stock has fluctuated. Sure, it's gone up, it's gone down, it's gone up, it's gone down. Who cares? The trend over a very, very long period of time is always up, always. You have these little microbursts in and out in a day. You'll have, short-term gains and short-term losses over a month or a quarter, even over a period of time where you have a big fall in the stock market. None of that should worry you, because your outlook is, what's the stock going to be worth when I'm 65? Which is a long time from now. So anything you buy now, you're going to look like a genius in 40 years, an absolute genius. Oh my gosh, I can't believe you bought that stock. That was so smart of you. And that's where I want you to have your head in that. And so I don't know if that really answered the question of what the stock market is, but I wanted to kind of talk a little bit about the difference here between speculating and investing, right? That's really what I want you guys to take away from that.
Okay, that was actually really insightful, because most people, whenever I see it, it's always seems to be like this big guessing game that everybody has to play. But now that you frame it as kind of a way to secure your future, I think that makes it feel a little safer, as opposed to it being like a big gamble that a lot of people portray it as.
Well, the funniest thing too about that is, at your age, what do you want to see the stock market do? You want to see the stock market crash. I mean, I hate to say that, but honestly, you'd love to see the stock market crash, because that means all of those stock prices have come down. In 2008 and 2009, before the Great Recession, the market lost half of its value. But then, 18, 24 months later, it was back where it was. And then it took off from there. So when you see this market crash, if you think about it, people are selling. That's what's driving the prices down, right? Everybody's freaking out. Oh my God, the market's crashing, and they sell. They panic sell.
Okay.
So as the prices of the stock are falling, as people are selling, of course, the other half of that means somebody is buying, right? It's not like it's a one-sided thing where you can just sell. No, I mean, somebody's got to buy it. So there's a name for people who did that in 2008 and 2009, as the market was tanking, and you saw these stock values lose 50%. You know what they're called?
I don't know. I'm afraid I don't.
They're called, yeah, they're called millionaires and billionaires, because they don't panic, right? They don't panic. They look at it like exactly what it is. Oh my gosh, stocks are on sale. I'm going to go buy some. And that's what they did. So actually, that was one of the greatest transfers of wealth in the history of our country. middle class people, lower class people who owned stock when they saw the prices fall. And they did the absolute wrong thing. They sold. People who had money, who understood the stock market, realized this is a once in a lifetime opportunity to buy these stocks at this low price. And they bought. Well, then when they bought at the low prices, the market went up. Of course, they reaped the benefit of that. So you guys actually want to see the stock market fall. That's the
Wow.
best time to buy. Buy low, sell high, right? That's the
Yeah.
market.
Wow. Okay. I also didn't think about it like that. Before we go any further, I want to ask if you can define some terms just for the sake of clarification. So what
Absolutely.
is a stock?
So a stock is a piece of an ownership.
Mhm.
So what happens is a company, let's use round numbers, a company sells 100 shares of stock.
Mhm.
So of course, they really sell billions of shares of stock. But
Mhm.
let's say they sell 100 shares of stock. If you buy one of those, that means you own 1/100th of the company. And in theory, you share in the rewards of the company. If the company does well and they're very profitable, you might actually get some of that money given to you in the form of a dividend, a stock dividend, where they distribute part of the profits to their shareholders. So if they just whatever they distribute, at that point you would get 1/100th of the distribution because that's how much of the stock you own.
Okay.
So it's ownership interest. It's an investment, clearly.
Mhm.
You know, the big investments are stocks, bonds, and real estate. There's others, but those are the big ones. And stock represents an ownership interest in that company. So you are an owner. You would be
Okay.
an owner. If you bought Google, you could say you own Google.
No. Okay. Cool. That makes a lot more sense. The next term I want you to define is the stock market. Now that you say stocks, it seems a bit self-explanatory, but that's still such a huge term.
Yeah, and the stock market is, and we generally use it as a singular stock market, but it really, the truth is there are stock markets, plural. There are hundreds of different trading platforms
Mhm.
in the country. So you might have heard of the New York Stock Exchange. That's a
Mhm.
trading platform. NASDAQ, a trading platform. But almost every country has at least two, sometimes 5 or 6 different platforms, right? It facilitates money being transferred to companies that can use it more efficiently than I could.
Mhm.
Okay, so if I had $1,000 to invest and I want to make money on my $1,000, how do I do it? Where do I go? How do I make money on my money, right?
Mhm.
I'm ill-equipped to do it by myself, but I can basically invest it in the stock market. And now all what I'm really doing is giving money to these companies so they can invest that money for me, right? They then take my $1,000. If I give my $1,000 to Motorola, or some company out there, they take that money. They're very efficient. They're very good at taking my money and turning it into profit. Much better than I would ever be, right? So it's this efficiency that we're looking for. Yeah, it's just
That's an
a
investment.
trading platform.
Mhm.
So we in the finance world would say there's a primary market and a secondary market
Mhm.
in all stock markets. Primary market is when the company sells to the public. And that's the one time the company's going to actually get paid for the stock, right? They actually do get the money. When they sell their stock, they take the money in. After that, and obviously the much bigger market is the secondary market. And that's where stock is traded amongst individuals or between investors. So that's where if you sold your Apple shares to me, chances are I would buy it basically through one of these trading platforms, like the New York Stock Exchange or the NASDAQ, where you offer it for sale and I buy it. We'll never meet. We may never meet. I may never know that it was your stock. I probably wouldn't. It's just that I want to buy the Apple stock and you want to sell the Apple stock. So how do we do that efficiently? We use these trading platforms, and that's really what the stock market is. Of course, they keep track of the stock prices, right? So that's why you're always looking in a day. You can watch the price of a stock fluctuate based on the trades and how much somebody's willing to buy and how much somebody's willing to sell.
Okay. Yeah. That helps a lot. All right. The next term I want you to define, you said it like a little bit ago was the word portfolio. What exactly is that?
Good question. So generally speaking, we'll talk about investments in terms of a portfolio. So you could have a stock portfolio, you could have a real estate portfolio, you could have a bond portfolio, and all that means is what your ownership of all of your stocks are. So if you owned 3,000 different types of companies, right? 3,000 different company stocks, that would be your stock portfolio. If you had your home, a rental home, maybe an apartment building, a warehouse, and they're all real estate rentals, that would be your real estate portfolio, right? It's made up of those properties. So that's the same for stocks. It's just a common phrase to say a group of stocks that you own.
Oh, okay, but just grouped up so that everybody knows, or that you know exactly what you've invested in. Oh, okay. But in the meantime, we're gonna go ahead and get started on student questions because we have
Yes,
some
please.
pretty intriguing ones. So the first one I want to ask is on behalf of Anonymous. For the first question, I want to ask, what are good ways to get started in investing, such as which apps, how much money, etc.?
How do you get started? Let me just say this, because it shouldn't be a complicated question, but there are little nuances in here. One of the things that I really like to emphasize is before you invest in the stock market, or in anything for that matter, you really need to establish an emergency fund. The reason I bring this up is because the Federal Reserve did a study years ago, and they asked people, could you handle a $400 emergency? Which frankly is not a lot of money for an emergency. And about half of the people in the country said either, no, I can't, or if I can do it, I'd have to borrow the money. In other words, they didn't have $400. So here we are in the pandemic. A lot of people have lost their jobs and they didn't have anything to fall back on. They had no savings to fall back on. And so they suffer this consequence, right? That you've lost your job and now what do you do? So most important, really, really most important, is to understand your money and have a budget. But the next thing is to have an emergency fund. And generally speaking, that should be, they say 3 to 6 months. I always say at least 6 months of expenses put away. So if your expenses a month are $5,000, multiply that by 6, that's how much money you should have put away in savings before you invest. Because you don't want to touch your investments. Once you make them, you want to leave them alone. But if there's an emergency, what do you do? So that's when you would go take from your emergency fund what you need. So do that first. Do that first. So then how do you start? So now you've kind of taken care of your emergencies, right? You're ready to go and you're actually focused and you want to invest. How do you do it? Most of us will do it through work, and we'll basically invest through the 401k plan at the company that we work for. That is the easiest and most convenient way to do it, is utilize the tool that it's there, right? So use that 401k. Once you establish that you're going to be an investor through the company, they take the money right out of your paycheck. You don't even have to think about it. It's done. Short of that, if you're an entrepreneur or you're starting your own company and you don't have access to a 401k, maybe a company you work for doesn't offer it, how do you get started? Some suggestions, right? And tell you how I would do it. But one of the things that I would look at is probably getting an account with a discount brokerage firm. And there's bunches of them out there. Schwab is probably one of the biggest. You can go to Schwab, and they're considered a discount brokerage firm because they don't really offer you advice. You can get a full service brokerage firm. Like if you go to B of A, they have Merrill Lynch, so you can go there. Merrill Lynch is a full service broker. They're going to give you advice. They'll help you sit down with somebody. They make you feel really good about your choices and what you're going to do, but they charge you. If you kind of have a general idea of what you want to invest in anyway, just go right to a discount brokerage firm and buy the stocks you want to buy. My suggestion is you try to get to a point where you're investing 15% of your income. Might sound high, might be something that you can't do right away, but try to get to 15%. because the earlier you start, the benefits are tremendous later on, tremendous later on. So my guess is that, my suggestion would be to start at 15%. If you can do that, that's great. Put in as much as you can. Which would you rather have, Maxine? Would you rather have $100,000 in the bank or in investments, or $100,000 sitting on your driveway?
I honestly would rather be financially secure, but because I'm kind of starting out, I don't know what that looks like quite yet. I think another thing too that I would want to ask is, let's say you don't have a company quite yet who's offering you a 401k, but you want to get started on your own. Would you go ahead and start with one of these either apps or like discount brokerage firms? Is that correct? Or mutual funds? Should we
Absolutely,
start
yeah.
there? Excuse me, sorry.
Go
Just
ahead.
how to start more so on your own, as opposed to
Right.
just waiting to be hired into a company. Yes.
Yeah, and for very, very little money, I mean, $50, right?
Yeah.
For 50
Yeah,
bucks, you
that's
can
awesome.
open an account at Schwab.
Mhm.
You can open an account at some of these discount brokerage firms that are online. They'll happily take your $50 and you can start executing trades right away. If you had, for $100, you can buy Schwab's S&P 500 index. And that is a very, very solid investment, in my opinion. Very solid investment. One of the things you want with all investments is diversification. You don't want to put all of your money into one company. I don't care which company that is. You want to diversify. Well, if you buy the S&P 500, your money is technically diversified because you have 500 companies you've invested in. Sometimes this group of companies will be doing well, and this group will be doing not so well, and then it'll turn. And but if you have enough if you have it diversified out, then those fluctuations balance each other out, and overall you do well. S&P 500 has routinely earned somewhere between 8 and 10% every year. So it's not a given, it's not perfect, it's not for sure, but you don't care, right? It's just over a very, very long period of time, you're going to do well in that investment, in my opinion. But you could do that with Fidelity, you could do it with Schwab, you can do it with E-Trade, any of these companies, and you can open it up for very little money.
Oh, okay. So easier again than I thought it would be. So the next question I want to ask then is, do I have to have hundreds to invest in the stock market? From Anonymous.
Obviously, you don't. You don't need to have hundreds. Like I said, you can open an account for as little as 50 bucks. You will eventually have hundreds in it, even if you start slow and you keep adding to it. That's the key, right? Is to be consistent and constantly invest, which is why I like the 401k scenario so well, because they automatically take the same amount out of your paycheck every 2 weeks. You're investing. It's great. Otherwise, you have to do it yourself, and you have to really make sure that you're paying yourself first. Take care of your needs, pay your rent, pay your food bill, pay your gas bill, and all that, but then pay yourself, right? Invest in yourself by putting money away for your future. And even if it's 50 bucks a month, it's better than nothing. And so do that. Try to get to 15%, stretch until you can get there. And then sit back and see what happens, right? Sit back and see what happens. I've had students send me emails and I've got my first $10,000, and how's that feel? Oh my God, this is great. I'm like, wait till you get your first 100,000. Wait till you get your first million.
That's a number you can reach.
That's even better. You know
Wow,
what?
yeah.
Oddly enough, yeah, at your age, if you did, I kid you not, I could show you the numbers. $300 a month from the time you're 23 until you're 65, you'd have about $1.7 million. See,
Wow.
it's like,
Yeah.
how do you become a millionaire?
You don't play game shows, you invest in the stock market.
Don't. Worst investment you can make, lottery tickets. Don't buy lottery tickets. What a waste of money.
One thing I do want to touch upon is consistency. What does that have to do with your role in investing? Like, I thought you just buy it once and you're good. You have to
You
keep
do.
buying?
Yeah, you would want to, what you want to do is continue to build your portfolio up, right? Keep investing. So unlike real estate, where you kind of have a big old chunk of money and you buy a house and then you hope that house goes up in value, and that's the only time you invest. With the stock market, you're trying to build a portfolio over time. And so every month, if you can do it every month, you're putting a little bit of money into your investment. Now that, again, it may be the same investment, it might be different investments. You might diversify out of the S&P 500 and buy, some other index, or you might buy some other mutual funds. But if you're consistently putting away money, you're consistently investing in this money, then as you build that portfolio up, it starts to grow, right? Just over time, the investments will start to grow. Stock that you bought today at $1,000 is worth $1,200. Other stock that you bought for $600 is worth $900. You did really well in that. And so over time, the portfolio gets bigger and bigger and bigger as far as dollars go. And you just keep feeding it. You keep buying more and more stock. So stock that you buy today, and you pay $300 for, 10 years from now, you might still be buying that same stock, but it won't be trading at $300. It's going to be trading at a higher amount, and that's okay. You're still buying the stock, and it's still going to continue to rise over a long period of time. Mm-hmm. But you just keep feeding it and increasing this portfolio and letting it work for you, letting time work for you to see the growth in that investment over a long period of time. That's really what you're after. So to me, the easiest way to do it, again, is just to be consistent, is through the 401k, because they're going to automatically take the money out of your paycheck. Otherwise, you have to remind yourself. You can set up accounts. I mean, I'm not saying you can't. You can set up accounts that will take money right out of your paycheck or right out of your checking account. You can do it that way too. But the point is to try to be consistent and always be a saver, right? It becomes a lifelong thing, where you're always a saver.
And really quickly, this just popped into my mind. Does it account for inflation?
Yes, and that's part of the problem. That's actually part of the problem that you're dealing with. Okay. Back when I was your age, or maybe a little bit younger than you are, you could get a brand new Mustang. You get a brand new Ford Mustang for under $5,000. I think they were like $4,300, right? Brand new car.
That feels like a lie. that feels.
I know, right? I mean, believe me, I actually had to get ads to show my students right out of high school. Absolutely, you can get a car for under $5,000, brand new. Brand spanking new. The average price of a house back then was $68,000. $68,000 was the average price of a house in the United States back then. Mm-hmm. Now it's over $300,000. Well, how much do you think it's going to be when you're my age? You're going to be buying cars that are going to cost $250,000. That's inflation, right? That's the effect of inflation. So when you're my age, when you're in your 60s, you're going to be out looking for cars, and you're hoping to get it for under $250,000. The average price of a house is going to be well over $1 million in this country. That's just the general increase in prices over a long period of time. That's inflation. If you do nothing with your money, you're actually losing value. You're losing this value of your money to inflation. And inflation runs about 2 or 3%. We want to see inflation. That's actually a good thing in the economy, right? As long as it doesn't get too high. But 2% is a very decent inflation. It shows growth in the economy. Things are doing okay. So 2% increase in prices, that's about right. So you have to find an investment that makes at least 2% just to stay even. That's why the stock market is such a good way to invest, because it generally returns between 8 and 12%, something like that. Depends on how aggressive you are with your portfolio. But even at 8%, your real return is at least 6. Or it's somewhere between 5 and 6 is a real return on that money after inflation. And that's what you need. So yes, inflation, that's the killer.
Moving on to the next question, we're going to go back on track here. From Alfred Vargas, we have, what are index funds, and are they smarter to invest in than regular stocks? So we talked about this a little bit, but I want to hear what you have to say a bit more in depth now.
Well, I'm gonna pick on the S&P 500, and there's a reason I do that, is because that's not just an indexed fund. It's the benchmark that all investments compared to. So what does that mean? If I had an audience of 10,000 students, and for whatever reason, I wanted to know how many of them are left-handed, I could do individual polling and ask how much, what hand do you use? What hand do you use? And 10,000 people later, I would have the exact number of how many of my students are left-handed. That's one way to do it. It's not efficient, but you can do it that way, right? A better way to do it using statistics is to take a sample, right? So maybe I ask 100 students how many are left-handed. And if it's 7% of my sample, I can say, if this is a random sampling, I can generalize and say 7% of this 10,000 student audience is left-handed based on my sample count, right? Basically what an index is, it's a group of stocks that somebody has put together, and it becomes a benchmark. But I particularly like indexes because they're very easy to track. Very, very easy to track. If you type in stock market and you Google stock market and you go to some website and you ask to look at the markets, the three things that are going to pop up are probably the Dow Jones Industrial Average, the S&P 500, and NASDAQ. Those are all indexes. And again, it doesn't mean that your individual stocks went up or down, but they're saying the trend in the market is up because of this sample, right? This index that we created is sampling the market to tell us whether or not, in general, the markets went up or down. But then to know if you did well, like the other day, for a while, the market was mixed. So the S&P 500 index was I think it was up, but the NASDAQ was down. So now you have these two indexes doing two different things. I go look at my portfolio was down. And that's really all that mattered to me, right? It's great that the one index is up and the other one's down, but how is it affecting me? And then you go look at your own portfolio. But if your whole portfolio was made up of nothing but the S&P 500, then all you'd have to do is go look at that index and you'd know whether you'd made money or didn't. But like all mutual funds, it's really designed for convenience. It's just convenient. Instead of you going out and buying a single share of stock from every one of these 500 companies, it's just much, much easier and way, way cheaper to just buy into the mutual fund. Because they've already done that. They bought billions of dollars worth of these 500 companies' stocks. And it's proportional to the capitals and all that. So to me, it's just an easier way to invest. Much easier way to invest.
Yeah.
Is it better? I can't really answer that. I will say this. The index, the S&P 500 as an index, I used to have what's called a managed broker account, where I paid somebody to buy my investments for me. And I really didn't take much interest in it. I just fed them a bunch of money and kept giving them money. And they were supposed to be doing good things with my money by investing. And every year or so, I would sit down with this broker and they would say, well, let's show you how you did. And they'd say, here's how much you made. And then, so if somebody said to you, you made 8%, is that good? Is it bad? How do you know, right? How do I know if 8% is good or bad? And so they'd say, well, you made 8%, and now we're going to compare it with something so that you know whether it's good or bad. And what did they always compare it to? The S&P 500, because that's the benchmark. So they'd say, well, you did 8% and the S&P 500 did 9%. So after a while, I'm going, well, can I just buy that? Well, and plus it's way cheaper. If you just buy the index, there's no management of it. You just buy it. And so it's generally speaking, it's a cheaper way of investing. And then again, I'm happy at the stock market. I'm happy with whatever the stock market does. I don't need to beat the stock market. I'm not really looking looking to beat the stock market. I'm happy if I can just make what the stock market makes. Again, over a 40-year period of time, long period of time. So to me, I like them. I really, really like index funds a lot.
Let's see. Next question is from Daniel. Can you explain marginal trading and optional trading? Oh, okay. That doesn't
Yes, I
bode
can.
well. That doesn't bode well, but let's hear it.
Yeah, let's do that. So,
Oh, first, can you
again,
define
yeah,
it?
yeah, I will define it, and then I'll tell you something about it. So,
Okay.
if you're buying on margin, what does that mean? You have a margin account. That means I'm actually borrowing money to buy stock. So usually whoever you're borrowing the money for, it's usually your brokerage account. If you have, let's say you have $10,000 in your brokerage account, $10,000 worth of stocks that you've bought. So you go to your broker and you go, I want to borrow $1,000. You have $10,000 worth of stock. I want to borrow 1,000. I'm going to put it on margin. I'm going to take that $1,000. I'm going to go buy $1,000 of stock. So I've borrowed against my portfolio. I've leveraged it, right? It's leverage. You have debt now, and I'm going to take that money that I borrowed and I'm going to go buy stock with it. It's a way to do it. That's a margin account, and you can do that for either taking money that you've got, borrowing it to buy stock, or you could buy stock on margin. So instead of paying the full price for the stock you're buying, you buy it for basically a down payment and then a promise to pay for the rest. But either way you do it, there's a debt to be paid, right? There's a debt to be paid here. So that's on margin. An option is a lot more complicated than that. An option is there's two different sides to an option. This gets really complicated, and I'll say it's probably a little beyond the scope here, but basically it's a contract that gives you the right, but not the requirement to either buy or sell stock. That probably doesn't make much sense. But let's say that a stock is selling for $1,000 a share. You enter into an agreement with somebody that you'll buy their stock for $1,100. You've put an option to buy their stock for $1,100. And then there's a period of time that you can exercise that option. And now you don't have to, you never have to. You could walk away at any time and say, I'm not going to exercise my option. But what happens if the stock goes up to 1,200? Now it makes sense to exercise your option because you can buy it for 1,100 and immediately sell it for 1,200 and make a profit, right? But if the stock goes down, instead of selling for 1,000, it starts selling for 900. Your $1,100 option is worthless. So you wouldn't exercise it, and you don't have to. It's an option. You don't have to buy it. So options are also sold. If you have an $1,100 option and the stock goes up for 1,200, you can actually sell your option to somebody. So it gets a little complicated and a little weird here. But then they have other terms, like a put is where you sell the stock. A call is where you're buying the stock. So they use these weird terminologies, but you're probably sitting there thinking, well, why don't you just option stocks all the time? It's because you have to pay a premium for the option. So yeah, you can buy my stock for 1,100, and maybe that option is open for 45 days or something. But in order for you to get the option, you're going to pay me a fee. So now it has to go up, right? Just to even break even, it has to go up a little bit, and then you have to exercise it. So there's a cost to these options as well. Here's the point. On both margins and options, that's not investing. That's not investing. investing, those are forms of speculation and almost gambling, really. Are there really smart people who make a lot of money on options and margins? Yeah, sure. And if you want to get into options and margins, suit up, get a degree in finance, become a broker, sit in front of your computer all day and trade, because that's kind of what it takes. It's sort of like somebody saying to you, well, I bought a piece of land, I'm going to build a house. Really? You ever built a house before? No, but I kind of know how to do it. Well, good luck with that. No, you're going to pay a professional to do it, right? This is it. And so it's like, you want to do that, then suit up. Go get a general contractor's license. Get an engineering degree, an architect degree, start a company. You want to build houses, do it. But, do it like a pro. You're doing it like an amateur otherwise. And that's what hurts. A lot of people think, oh, I'm going to get into options. I'm going to get into margins. But they do it like an amateur does it. Amateurs get eaten alive in Las Vegas, right? They don't know what they're doing. They go play poker. They get creamed by professional poker players, right? They're going to go play blackjack against the house. Good luck with that. And that's what this is. It's sort of a form of gambling. What I'm talking about is investing. Buy stock. Tell me how you feel in 40 years.
Okay.
That's investing.
Interesting, because that term also gets thrown around. So thank you for defining.
You got to be on your game. It's like day traders. There's a lot of people that day trade. They literally look at a computer screen and they watch for stocks to these little micro movements, where the stock goes down 15 cents, they buy it. And then it goes up 30 cents and they sell it. And they're making like these little micro trades all day long and day trading. Can they make money? Yeah, they can make money doing it, but it's a full-time gig. You can't look away, because then the stock moves. And you go, well, what happened? I lost my opportunity. So that's kind of the same thing with any of these, hedge funds or any of the derivatives, any derivative kind of investing. That's a little bit more. It just takes a more practiced, intelligent way of investing. Actually, what I'm talking about is kind of lazy investing, to be honest with you. It's just buy the stock and hold on to it, and I'll see you in 40 years. Who cares if it goes up or down in the meantime? You're going to look like a genius. So just hold on to it. That, to me, is more of a sure bet. If you want to take a little bit of money and go buy some of these more exotic, riskier types of investments, you want to go invest in commodities, oil futures and stuff like, great. Maybe a little bit of your investments can go in there, but that's if you have the time and the mentality to do it. I'm not talking about that. What I'm talking about is investing, which is buy it and wait, so that in retirement you'll have something to fall back on.
Okay. So to just summarize, it's basically just a way more active version of investing.
A
way
lot riskier.
More active. Okay.
Way riskier.
Okay, cool. Okay, cool. Gotcha. With that, hopefully that answers your question, Daniel. The next one is going to come from Anonymous. This is also another compare and contrast type question. What's the benefit of investing long-term and short-term stocks? How do you know which stock will do best? That's a big question that I have too. I was like, how will I know?
I'm going to be flat out honest and tell you, I don't know. And guess what? Nobody else does. There's nobody, unless you are cheating the system, and there are ways to do that. It's illegal. But unless you're cheating the system, everybody knows exactly what everybody else knows at the same time. Nobody's smarter than anybody else when it comes to this, okay? Are there ways to do research and to prognosticate, to guess? Maybe you have a better guessing tool than others, sure. But who saw the pandemic coming?
True.
Who shorted the Carnival Cruise Line stock, knowing that the stock was going to fall? Who knew that? A year ago? Nobody. Absolutely nobody, right? You can't predict this. And so if you look at it, and I was talking about these index funds, which are not managed, there's nothing to manage, right? It's like there's, the Dow Jones, here's the 30 companies. They don't change. There's nothing to manage. Here you go. S&P 500. Here's the 500 companies. Done. So you have these managed accounts or these index funds, and they have the managed accounts. But if you look at the numbers, the reality is only 5% of the time do managed funds beat the S&P 500. Only 5% of the time do they consistently beat the S&P 500, which means 95% of the time they don't. Why? Because what do they know that you don't know? What do they know that everybody else doesn't know? So you're looking at a stock. You're looking at Google for whatever reason. You're looking at Google and it's trading at $1,000 a share. And you see Google go down $3. What does that mean? What does that mean to anybody? Why? Why did it go down $3? What happened? And it could be it's raining in Spain. I have no idea. You know, it's the butterfly effect. I don't know what that means. It's went down $3. So do I think it's going to go back up $3? Maybe. I have a chance it'll do that. It was there before. Maybe it'll go back. I don't know. Nobody does. Until the company actually announces something. And that's where the insider trading comes in, right? That's how you cheat the system. If you knew for a fact that Google was going to beat their projection, so they said they're going to make a 10% profit, but now they have their actual number. So we've been trading, everybody's been trading on this assumption that the stock, the company is going to make a 10% profit. But now they're going to release their quarterly earnings and they made 15%. So they beat the number. That means the stock's going to go up because they're clearly more profitable than you thought they were going to be. So more people are going to want it. If you knew that before the announcement, you would trade on that. You would trade on that and you would beat the market because you had this insider information. And then you would be arrested and sent to prison because you can't trade on insider information. It's illegal. But short of that, everybody knows exactly the same thing at the same time. When they announce that the earnings went up, everybody knows it at the same time, and that's when trading starts. So there's no way to beat the system, is what I'm saying.
Oh, okay.
Yeah.
So my takeaway, if I could add, is to me, it seems like it's not so much guessing which stocks will do best. It's making sure that your investments are diversified enough so that it makes up for that, as opposed to just pointedly investing straight into Google or straight into Apple or straight into, does Microsoft have one? I don't even know.
Yeah.
Like it would be better to diversify so it can make up for those little things that happen.
And there's no saying, don't get worried about the daily fluctuations of this, that, or the other thing. Just keep investing. Just keep investing.
Okay, cool. So back to the first part of this person's question, what's the benefit of investing long-term and short-term? We kind of touched upon that, I believe, the sort of quote unquote lazy, you give it a little bit of money and then you put it away for 40 years. But the short-term, I think, is what kind of is catching my eye.
It's a great question.
Yeah.
And
okay.
And so
could you explain that for us?
Well, let's say you do short-term. So you're going to buy something. Your intention is not to hold it for a long period of time. Your intention is I'm going to buy it and sell it in a relatively short period of time, maybe a year, maybe 2 years. And this is what happens to, as I was saying in the recession in 2008, 2009, when the housing market crashed, the stock market, as the stocks were falling and people were selling, what did they do with the money? Now what? Now you have the money, you've sold your stock, now what? And that's what I would say with short term. So you're going to buy something and hold it for a short period of time, and now what? What are you going to do with that money? You still want to invest it, right? This is your investment. This is your future. So what are you going to do? And so if your thought is, I'm just going to constantly trade short term. I'm just going to buy, sell, and do this. I'll have students ask me that same question in a different way, which is, and this is short-term, long-term, same thing, is they'll say, is there a bubble in the stock market? In other words, is the stock market overpriced? And I'll say, yeah, it absolutely, I think, in my opinion, the stock market's overpriced. There's a bubble in the stock market. What's your alternative? What am I going to do? I'm going to take my money out of the stock market and do what? Go into real estate? I don't like real estate as an investment. Again, so that doesn't work for me. Do I want to put it into bonds? Bonds are paying less than inflation, which means if I put my money into bonds, I'm actually losing money to inflation every year. That's no good. What's left? Don't like real estate, don't like bonds. What am I going to get into? Coins, collectibles, antiques, art. I'm going to go buy exotic cars and hope they go up in value. I mean, what else is there? So you pull your money out of the stock market and you go, oh, I guess I'll buy stocks with that. And you're right back. So it's a long-term investment is my point. It should always be a long-term investment. Can you make money short-term? I suppose, but that's not my intent. My intent is to make money in the long term. I don't want the money for next year. I want the money for my retirement. Having said that, if I knew I was going to buy a house in 5 or 7 years, would I put the money in a savings account, or would I be better putting it into an investment, like an index fund? I'd probably be better off putting it into an index fund. And that's relatively short. 5 years is a relatively short period of time. But if I thought, well, I'm going to take this money and it's going to be my down payment for a house, sure, for a short period of time like that, 3 to 5 years, I would absolutely put it into a short-term investment for that, because there's a purpose at the end, right? There's a purpose for it. Then I would pull the money out and go put it as my down payment on a house.
Oh, okay. So you can kind of pull from your collective investment at any time, but it is better to keep it long term.
And of course, there's tax consequences on
Mhm.
all investments. You have to think about that too. But
Yeah. I'm also, that actually, again, helps. I know I say this every question, but it really is very informative. So the next question is going to be from Kimberly Fuentes. Oh, also, thank you. Hopefully that answers your question, anonymous. But from Kimberly Fuentes, we ask, how does it affect your taxes? So number one, do you want to start with that?
yeah, let's talk about that. There's and it's a great deeper dive into this, which is useful. There's a couple of different ways that you can invest using your 401k or in IRA, an individual retirement account, if you want to open up one of those. There's a couple of different ways to do this. So one is a traditional investment, and the traditional investment takes money out of your paycheck before taxes. So if you were making $50,000 a year and you took $10,000 out of your paycheck for an investment, which would be a lot, but there it is. Instead of paying taxes on $50,000, you pay taxes on $40,000. It saves you money right now because it shelters this income. Now, some point you start pulling the money out in retirement. When you take the money out of the investment, it's taxable, which means you're going to pay taxes on the money as you pull it out 40 or 50 years from now. So that's a traditional way of investing. Then there's something called a Roth IRA or a Roth investment. You can do this through your 401k as well. The way a Roth IRA works, it takes money out after taxes. So if you made $50,000 a year, you pay taxes on the $50,000, right? And now you take $10,000 of that post-tax earnings and you put it into a Roth IRA. So you've paid taxes on that money, put it into the Roth, and it grows and grows and grows and grows over 40 years. Doesn't matter. Maybe it's worth millions of dollars. Who knows? It doesn't matter. When you pull it out, it's all tax-free. Not just the $10,000 that you started with, but all of the money that it's earned is 100% tax-free when you finally go to pull it out 40 or 50 years from now. Which is better? I don't know. It's situational. It's very dependent. I was fortunate that I had a very nice income when I was working. And so I was looking for a way to shelter that income. And so for me, traditional was the way to go. I wanted to pay less taxes right now. My thought is in the future, as I pull money out of my investments, I'm only going to pull out as much as I absolutely need. And so I'm going to try to reduce my taxes by not pulling out too much money. Other people think of it another way. They'd rather have all of this money earning tax-free, where it's tax-free, and now they can pull out as much as they want, and they can go to they take that fabulous trip to Africa for a month, and do a safari, and it cost them $100,000, and it was all tax-free because the money was sheltered. It really depends, and there's nothing to say you have to do all or the other. You can do some as a Roth and some as a traditional, and have a little bit of both. But taxes are definitely a very personal, individual thing, and everybody's situation is a little different, so it's hard to answer that question directly. But hopefully this gives you some ideas.
For me personally, I think the Roth IRA would be my style, but I don't know. Let's see what the future holds.
Right.
But that was enlightening. And the second part of this question, I had to break it up and take some of it out, was how do you read the graph, which is the stock market graph? And how do you determine if you should invest in a company based on previous wins and from the graph? We kind of answered this in the previous question, but how do you read the graph?
So you see that graph here in this corner?
Yes.
And that's just stock graph, S&P 500.
Yes.
Pops it right up. So this is more traditional graph that I'm used to seeing. And
Okay.
what I want you to look at is, if you look on the left-hand side, these numbers are the price of the S&P 500, this index. How much are they charging? So in this case, it's how much is the S&P 500 worth per share, right? So this is $3,875.44, and you can see the fluctuations here, right? And this is over a period of time. So this is from 10 o'clock in the morning. Along that, is that the y-axis, right?
Yes.
From 10 o'clock in the morning until 4 o'clock in the afternoon.
Oh, that's the x-axis.
Yeah, x-axis. Sorry, but you can see these fluctuations in the stock price, right? So it opened here, and then it closed here. So you can see the difference. But that's only for a day, which goes along the top here. You can change it to a 5-day look by clicking on that. You can look at it over a month. You can look at it over 6 months, and you start seeing a trend, right? This is what I'm talking about, where even over 6 months, you can see how the market trends upward. Are there individual days where the market dips? Absolutely. Look at this dip right here, huge. But then what happened? It recovered and it started to grow again, right? So that's 6 months. You can look at 5 years, same thing. Look at the trend. Were there times when the market tanked? Sure, right here. When did you want to buy the stock? I wanted to buy it right there, right at the bottom. I wanted to buy it and then grow it back up, right? Hold it till it's back up. So again, this ever changing graph, right? But look at the trend line. That's what you're really looking at. And this is over 5 years, Looking at it from a single day, yeah, there's little micro bursts in and out there, but a lot of it, there's not much that changed in a day. But over 5 years, huge difference from 2000 to 3875. That's a big growth. That's a lot of growth. Then they even go even farther out, and you can see, this is what I'm talking about. This is your life right here, right? This is over a long period of time.
Yeah, I see it. Sorry, I didn't mean to interrupt. I see it from just 6 months, and that's a jump. That's a huge jump already.
Yeah.
From where it started 6 months ago. Yeah, that's wild.
And so you can imagine if you started with $100,000 back in the early 90s, it's worth millions now. Millions now. Yeah. And that's what you want. You want this kind of, are there individual, tanking that happened? Sure. There's times when the market climbed and then boom, look at that fall. Look at that long period of time where it fell. But then what happened? Well, it came back up and then it fell and then it came back up and then it came back up and up and up and up. And there's individual periods of time, but you're looking for those overall long periods, that overall long period of trending upward. Again, so that's kind of how I read those graphs.
I didn't know they had that feature where you could see it from time, but that kind of helps put it into perspective how a little really does go a long way. So
It
thank you for
absolutely
that.
does. No problem.
Okay, cool. And then the next part of Kimberly's question was, how do you determine if you should invest in that company based on previous wins from the graph?
Yeah.
I mean, just to give a little bit of student input, looking at it, I was like, man, if I had been there in that short amount of time, I would have panicked a lot. And I definitely see like how it goes, how you see the upward trend and you like are just immediately excited about it. But emotionally speaking, I'd feel both enthused, but then I wouldn't know what else to do after that. Would I go off my feelings and sell, or do I just keep on investing? And I think that's a big thing some students, me personally, would have trouble tackling, because that temptation is there, like you should sell it now. And it's like,
Right.
no, it's gonna get
Yeah, I mean,
higher in like 6 months.
I remember as a kid, I wanted a bike. It was what I wanted, this bike, a particular bike, and there's no way my family was ever going to be able to afford that. And so I started doing jobs around the neighborhood, mowing lawns and washing windows and washing people's cars, anything I could to try to, make money. And as I'm making this money over the summer and whatever, I was thinking about getting into Little League, and you have to have a mitt to play baseball. So I was looking at this mitt and thinking, well, I could buy the mitt, right? And that would satisfy this immediate need that I want, this mitt, and I can go play baseball. Or I can keep saving and eventually buy this bike, which seems like it's a long way down the road, especially as a kid. You think a month is forever, right? So like, I'm forever before I can get this bike. But if I buy the mitt now, it sets me back even further. And that's kind of how you have to think about your investments. You're really investing for your retirement, right? That's the goal, is I can retire without having to worry about money. I can retire with financial security. How do I do that? I invest now, and 40 years from now, 50 years from now, that money is going to be there to sustain me until I pass away, right? So if I'm 61, if I'm 61 now, I've been retired for a couple of years, but if I'm thinking about how long that could be, for me, maybe I've got 20 more years, 30 more years, I don't know, something like that. But honestly, with you guys, when you think about the advances in medicine that are occurring right now, it is extremely possible and likely that you'll live to at least 100. Maybe 110 is going to be the new norm. So that's a lot longer that you're going to be retired if you want to retire in your mid 60s. So that just means you have to grow a pretty big portfolio. So even more incentive not to take money out of your investments for something that you want right now. So yay, the stock market's up. Yay, I've made money on the stock. Okay. So what? What are you going to do with it? You just forget about it. Leave it in there. Let it keep growing.
Yeah, it's kind of interesting because a lot of media really plays on the fact that you want to win the stock market and you want to win it fast. But like speaking about it, I think the reality that I'm starting to learn through this conversation is most of the time we're not going to win right away. We're going to win 50 years, 60 years in the future.
Right.
So that's a really sobering, realistic way of looking at it that kind of is true for the majority of people. Because personally, I'm not looking to I guess I was looking to make fast money, but now that you're talking about financial security, it's like, oh yeah, I should definitely think about that more than trying to actively figure out like if I should do this now or if I should sell now or should buy now, because that just seems super time consuming. I have other things to do, right?
Very complicated, and you're still just rolling the dice.
Yeah, I think it's another interesting thing too, because I'm sure there are other people with different financial investment philosophies. So
Oh,
it's
there
like,
are.
even though the two of us are talking and we both agree financial security is the best, having this insight is like, oh, maybe this is more for me or this is more for me. So
There are people who really, really enjoy taking risks, and
mhm,
they're very, very risk. And I'm not risk averse. I'm willing to take a risk, but
mhm,
I'm not willing to take a high risk. I want an educated risk. If you don't
yes,
take a risk, you're not going to make any money, because that's just
mhm,
how it is. You have to put your money at risk, and
mhm,
buying stock is risky. But for how long? So the market falls. Can I ride that out and not worry about it? Yeah, it's what I've done my whole life. I've just said, whatever, I don't care. Market's down. Oh, well. Actually, if the market's down, when the market tanked because of COVID, I was calling my broker going, I want to buy some stocks. Let's look at these stocks that really tanked. Do I think
mhm,
Carnival Cruise is going to go out of business? No. Someday they'll be back, and then the stock's going to go up. And
mhm,
you look at some of these companies that lost a lot of money at that for that little moment in time. Good time to buy their stock? Yeah, I thought so.
mhm. This is just kind of a philosophical question. Is that kind of lecherous? Like, is that mean?
Predatory.
Yeah, predatory. There you go. Is
It's a,
that, would you consider it like that? This is just a philosophical question
um,
now that we're talking about it, because I remember being like a
it's
young
a good
person.
question. It's a good question.
Yeah.
Yeah.
No, I
Go ahead.
remember being young and thinking, and I saw all these posts, again, a lot of social media presence, back when in high school and stuff, in the stock market crash. I was like, these people are being predatory, and like that's what a lot of people were saying. But now that you say it, you're just like, oh yeah, that's just life. Like that's just what you do.
It's it is predatory in its way, but I think it's recognizing an opportunity, just seeing an opportunity. And I don't, um, it's also how you view wealth and how you view money and what does it mean to you and all that. To me, I'm not a flashy person. I don't spend my money to show off. I find that kind of offensive, actually.
It is rather
To
gauche
me,
sometimes.
yeah,
Yeah.
it is, and to me, it's money represents safety and security, because I've lived without. I've had times in my life where I haven't had food, and I've never wanted to go back to that. I don't want to do that, and I've always wanted to provide for my daughter and be self-sustaining and be financially secure. That's all it is, just being financially secure. I don't need to be Bill Gates. I'm okay with that. And if somebody else, again, their relationship to money is such that they're not going to be happy unless they're driving a Mercedes or a Ferrari and living in Holmby Hills, and that's great. Then go get a job that'll pay you just a buttload of money and go do that. So it's there is we spend time in my classes talking about your relationship to money. What does money mean to you? Because that helps direct other steps in your life, right? If money represents the ability to own stuff, if that's what's really important to you, or is it safety and security like it is for me? Is it are you goal oriented? You want money to achieve goals in life? That's different than somebody who's just completely unconcerned about money. And I know people who are like that, who's completely unconcerned about money. They don't think about it. I can't be like that, but that's how they are. And so, money represents different things to different people. And but you're right. It's philosophically, how do you want to do it? And there are people who will invest in things that are only good for the earth, and I commend that. I think that's a great way to invest. Um, I don't want to invest in things that hurt the earth. I'm not looking at that. I don't look for people, companies that are deforesting South America, killing the Amazon. That's not something I want to invest in. And so you can direct your money, direct your investments accordingly. If you don't care about the forest and you think there's a lot of money to be made by deforesting, then I guess you're going to be okay with those kind of companies. But if you're not, then don't invest in them.
Yeah, that was just a question that popped into mind as we were talking, because I remember that stock market crash and everyone and all. and I was surrounded by people saying, this is predatory, people are being selfish. And like you and I are talking, and it's like, I'm just making sure I'm okay for my future. And I think that's how I'm going to be approaching it from now on as well.
And
Uh,
this is, you're not going to learn everything you need to know in 2 hours. You're not. I mean,
oh
there's
yeah,
no
for
way.
sure. No.
It's just, but and there's a lot of things that you can read and a lot of classes you can take and things you can find on the internet and so on. Um, just do your own research. Come up with your own philosophy of how you want to go about doing these things. And then, to me, again, what worked for me was being a consistent saver, investing for the long term, and keeping that in mind, and not worrying about these individual days or months or even trends in the market, where it's a 3-year trend downward. Okay, that's all right. I'm not looking to do anything in 3 years. I'm looking to do something in 40 years or 50 years. And that's what's worked for me. So
How do you determine if you should invest in a company?
it's a good question. And again, nobody knows, right? Nobody knows anything more than anybody else. It's just how you feel about that company in some cases. Like, I love Disney. Love Disney. I think they're an awesome company. They have a lot of diversity to them. They're well run. They're profitable. They have the parks. They have ABC. They have ESPN. They have Marvel. Now they have Pixar. They've got all these companies, and I just think they're great. So I know a lot about the company, and that's why I'm willing to buy Disney stock. Um, do I look at their trend? Do I look at where they are? Sure. Does it bother me one way or the other? No, I'm going to buy them anyway. I'm probably just going to buy them anyway. And maybe that's stupid. Maybe other people would look at that. There's investors out there go, that's a crazy way to invest. You have to wait until the stock does this, and there's these kind of ratios and blah, 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 blah. And that's fine if you want to do that. But past success does not guarantee future success. The biggest store when I was your age was Sears. They're gone. They didn't evolve. They're gone now. They were the largest retailer in their history. So is there some proof, something that I can say is absolutely going to be there? I don't know. I don't know if Apple will be around in 50 years. Will they? I don't know. Possible, but I don't know. And so picking winners and losers in a short period of time, if I'm looking at a trend, that doesn't mean what they're going to do in the future is going to be successful. I don't know. So it's all, in a way, it's all of a guess. That's why you diversify and buy a bunch of companies, because most of them will be successful and some won't, and that's okay.
But from our previous discussions, it is mentioned that the ongoing trend is it will always be upward.
The trend for most stocks over a long period of time is upward.
Okay.
Doesn't mean individual stocks won't fall and some will never recover. There are people who bought Sears and that's gone, and that's just the way that works. But if that was only a little tiny piece of your portfolio, who cares? You've got others that have made up for it. You bought Google and now Google's taken off, and so that's why you diversify.
Nice. Just for a quick question, not that any of them have been quick now that I think about it. What does it mean when a stock is gone, when a company is gone? Let's say you invested and now they're quote unquote gone.
Yeah, Sears went out of business.
Yeah, do you get your money?
They filed bank. No.
Okay.
No. Shareholder, you're the owner of the company.
Mm.
So you're actually, the term we use is you're the residual owner. You know what a residual is? It's like the last little bit.
Like
that's
a trace of it? Yes.
Yeah, it traces.
Yeah.
So when they file bankruptcy, a company files bankruptcy and they're going to go out of business through a Chapter 11 proceeding or whatever, they have to pay off everybody before you, because you're the last owner. So they pay off all the people that have rights to that money before you. They pay off the lawyers, of course. They pay off the courts. They pay off the tax person. They pay all their taxes. They pay their workers. They pay their creditors. The banks that loaned the money. They pay all those people way before they get to you. And if there's any money left, which there almost never is, whatever's left then gets distributed amongst the shareholders. But by that time, there's nothing left, generally speaking. So if a company like Sears goes out of business, you've probably lost 100% of your investment. It's gone.
Mhm.
It's just how it is. Doesn't happen very often. And generally what happens is, and it's weird in a way that it happened for Sears, but as the company starts to slip, they generally find a buyer and somebody buys it and they try to revive it. And that did actually happen in Sears. It traded hands and so on. And there was times where you could have sold it all along. You could have sold that stock. And if you look at a company and you think the long-term prospect on that company is not good, yeah, you would definitely get out of it and sell it. Look at trends. Look for trends. Look for ways to guess what you think is going to happen, because everybody else is doing the exact same thing. We're all trying to guess what's coming. And then how does that affect the stocks that I have?
So far, bunch of educated guesses, but lead to a great success
If
when
you have
done
enough
right.
diversity, right?
Yeah. I want to go to, I think, my favorite question that was sent in. How do you invest without feeling you're getting played, from Anonymous? I think this is my favorite question
Yeah.
because, like, they're surprisingly, for how complicated it is, there's a lot of emotional investment as well as financial investment that goes into it. When you see those
Yeah.
red versus greens and those down versus ups, there's a lot. So how do you deal with that? How do you feel like you're not getting played or such?
Yeah.
Yeah.
I mean, a part of it is just education, right? You just educate yourself on investing and companies in general. And some people have an aptitude for that and some don't. My wife has zero aptitude for finance. She just isn't her thing, and that's okay. And I just keep telling her, don't worry, don't worry, don't worry. That's all I can do. But yeah, if you can educate yourself a little bit more and feel better about how the market basically works, that might help. Um, if you're directing your own investments, then uh, and again, so much of it is that thought process of, I'm going to buy it today and I'm going to hold it for a really, really long period of time. 40 years is a long time. 50 years is a long time. It's, do I care what happens in the next month? Yeah, I guess, but is it going to bother me? No. I'm in it for the long haul. And that hopefully gives you that peace of mind too, that you think, well, I just bought this stock for $100 and now today it's worth 90. I feel like I got taken. Well, you didn't. It's just the vagaries of the market. It's just how the market fluctuates. Wait a month, wait a year, see what happens. Maybe it's back up to 90, maybe it's 120, and now you're going, oh, I knew it all along. It's like, come on. So just relax. That's part of it. Is just be lazy, be a lazy investor. Just put money in and let it work for you. Don't think about it much. Can you get taken? I guess is another question. Can you get cheated? Yeah, you can. That's why you probably want to go with a reliable company. You don't want to go with Chucky's House of Investment. No, thank you. You go to a Schwab, go to an E-Trade, go to a Merrill Lynch, go to a company that's substantial and deal with either do it yourself, self-directed, or if you're going to work with a broker, then find a broker that you're comfortable with.
Part of it does feel like a gamble, but it's also just making sure you make an educated guess.
Yeah.
It's
And I
less like a
think,
gamble and more like an educated guess.
right, exactly.
Yeah.
Exactly.
Go ahead.
And
Sorry.
because gambling there are ways to invest that feel a lot more like that, like a gamble, like a pure gamble. And again, it's the short-term kind of day trader, uh, you know, people doing these weird exotic investments. So yeah, of course, you're taking on a tremendous amount of risk. You want to do margin accounts, you want to do options, you want to do hedge funds, tons of risk in that. Is there good reward? Sure, if it pays off. Do you need that? I don't know. I mean, to me, that's not investing. That is sort of a form of gamble, of like taking a gamble. Nobody knows any more than anybody else on these things. Again, there's no way for me to tell you exactly which stocks to invest. I would never do that. I would never tell somebody, here's the stocks to buy. I don't know that. Nobody does. Can I take a guess? Yeah. Mostly I guess because I like the company and I understand it. I understand Apple. I understand Google. I understand Amazon. I understand Disney. I understand 3M. These are all companies I really like, and I invest in them. And to some extent, I shouldn't say I like them, but you know what I'm saying. Sometimes they do some weird business practices I don't like, but I'm just saying overall, I kind of have a better feel for some of these companies. But they're safe. They're relatively safe compared to other investments.
Okay. Yeah, that really helps tie it all together. Before we go, I wanted to ask, because we went over so much information, I want to ask what your 5 takeaways are that students should take away with them. And then I will also list my 5.
I could do 5 right away. I know
Go ahead,
exactly what
go
I
for
would
it.
say. So it's be a saver, be a lifelong saver. Have an emergency fund so you have a backup. You know, the federal government tells us that having 6 months of expenses is the difference between staying in your house and becoming homeless. You don't want to ever do that. I've been there, don't want to do that. So have an emergency fund, invest with a long-term outlook. You know, invest in a long-term outlook, be consistent, don't touch the money, let it grow, and then enjoy your future. Enjoy your future. Join the Alumni Association. I'm the president of the Alumni Association, so join the Alumni Association.
For me, as a student and as someone who learned a lot from this, I would say the first thing I took away was it's complicated, but it's not impossible. Another thing is have an emergency fund, like we talked about. Another thing is have a secure sense of your financial philosophy. I didn't think I really had one. I knew I liked saving. I didn't know how long. So having a good sense of your financial philosophy will help you drive your financial decisions. Do it less about making it on the short term and thinking about the long term, which is what we also talked about, and take it all in stride. You may have some failures, you may have some ups and downs, of course, but it will eventually come together. Also diversify.
And what are your alternatives? So
Yeah, for sure. That's going to be all from the 2 of us today. Thank you so much to anybody who's watching this. I hope this was educational for you guys and that you learned a little bit on how to invest in your future in stocks. Would you like to provide your contact information? If people want to reach out to you?
Yeah, absolutely. Yeah, it's W. Stevenson, Stevenson, W. Stevenson at csusb.edu. And feel free to take my Finance 1001 class.
That's it for me. My name is Maxine Vista. It was a pleasure being your host today. Thank you to our guest, Professor William Stevenson, and we'll see you in the next program. Bye.
Thanks, everybody. Bye.